Hi, and welcome back to our primers from Mrs. LTC on insurance, VA benefits, Medicare, and all things related to long-term care. My name is Stana Martin, and I do own an insurance agency called Mrs. LTC, where we do specialize in long-term care financial products. We also file claims for people who no longer have an agent to assist them. Today's topic, our little primer, is the difference between traditional insurance and the newer hybrid or linked benefit policies. We get a lot of questions from people about, well, which one should I go for? So let's see if we can kind of lay some groundwork on this and get you oriented as to how they each work, what their advantages and disadvantages are, and that way you can decide which one you should look into. There are really two broad flavors and only two broad flavors right now in the market. There's these traditional products. I'll explain how they work. And then there are these hybrid combo or linked benefit products. So let's talk about each one of them. Traditional works like your car insurance or your homeowner's insurance. Really, you pay the premium and you pay the premium. And if you never, ever make a claim, well, premium's gone. There's no cash value accumulating in these. Now, a few carriers, a very few, still have this thing called return of premium. So if you're shopping a traditional and that's important to you, that, well, what if I never use this? Ask about return of premium. If it's a possibility, it'll add some to your premium, but it just means that if you die without ever using it, all the premium returns to your estate or to a beneficiary. Not every carrier has that anymore. That's kind of disappearing out of the traditional market. Okay, on a long-term care traditional policy, there's really 4 or 5 main parts here. The first thing is, how much is it going to pay every month or every day for your care? Always that's going to be in today's dollars, because you would put an inflation guard on it, 3%, 5%, something like that, if you want to make sure that it's growing to keep up with the rising cost of care over the next 15 to 30 years of ownership. So think, how much does it pay in today's dollars? Does that grow over time? How long will it pay that? Will it pay it for 2 years, 3 years, 5 years? Is it a clock like a calendar, or is it really a total pool of money? A calendar really says if it pays 2 years, it pays 2 years and then it's done. If it's a pool of money, it might last longer than 2 years. It might mean that 2 years is the minimum it could pay. And if you're careful about how you use your benefits, it might last longer than that. What's your elimination period? Now, elimination period is really your deductible. That means there's a set window of time that you pay 100% of the cost of care, and then after that, the policy will kick in and start to pay its portion. Usually your elimination period is 20, 30, 60, 90, 100 days. It varies by carrier. But like all insurance, the more your deductible, the cheaper the premium. There are going to be some other bells and whistles. Those are your 4 main parts. A lot of times we see spouses, partners will like the shared care option where you link your policies together, and then that way you can drink from each other's bucket of money if you drink yours dry, or if one of you dies with money still in your bucket, the other spouse inherits what's left. So a lot of couples like that. Some people really like the waiver of the elimination period for home care. That just means that this deductible, this elimination period, is waived. You don't have to pay it if your care starts at home. So some people like that feature as well. There's other features, but I don't want to get bogged down in that. Really, your main parts are, how much does it pay? Is it growing over time? How much total money will it pay, or how much time will it pay? And what's my deductible? Okay, so that's the traditional. That's how it works. Your hybrid or linked benefit is almost always built in a life insurance or an annuity product. And so it has a long-term care rider on the back side. And how does that work? Well, it has the same elements on the long-term care as your traditional. How much will it pay? How long will it pay it? Is there a wait window, an elimination period, a deductible that we have to do? And is it growing to keep up with the rising cost of care or not? But this also has some kind of other benefit. If it's a life insurance, for instance, it's a death payout. So if you never, ever need the policy, there is a death benefit that will pay out to your estate or to a beneficiary that you designate. Now, what's interesting about these is if you do need long-term care and you don't need it for very long, you might not have used up very much long-term care. So the death benefit now is typically said that it pays your death benefit minus less whatever that paid for long-term care. So if you don't use long-term care long enough to meet the entire death benefit, there's still some death benefit left. A few carriers out there have what's called a residual death benefit. That means if you have a really long and protracted run of long-term care and you exhaust the death benefit, they still have some little pool of money they'll give you just to pay some funeral expenses at the end. So you might ask if there's a residual death benefit as well. Well, how do you fund these? A couple of different ways. Most of the time people will fund it with a lump sum, a single pay. They tend to be anywhere between $50,000 per person to $200,000 per person. It really depends upon how much long-term care benefit you're trying to get. The more premium you put in, the more death benefit, the more long-term care benefit you're going to get. There are a few carriers out there, though, that let you make annual payments. Some of them let you pay for 10 years, 20 years. There's even one carrier I know of that'll let you pay an annual payment for the rest of your life. Anytime you drip the money in over annual, though, you often are getting a lower cash value and lower long-term care benefits and lower death benefit. So you might want to compare that. If you've got a way to fund it as a single pay, that's really usually your best benefits by far. All right, well, should you get a hybrid? Because all people say to me, well, a hybrid sounds pretty good. I mean, I either die and I get my money back, or I have long-term care and I get my money back. Why doesn't everybody go that way? Well, as I said on their pricing, they are not cheap. They're going to be more expensive than your traditional, and you're getting less long-term care payout. You just got to be logical about it. You don't get your cake and eat it too on these. If you're going to get a death benefit, the same premium is going to get you a death benefit and less long-term care in a hybrid. Or you've got to put in way more premium to get the same long-term care payout. So here's the kind of candidates that I think should be looking at a hybrid. Are you an asset-healthy household? All right, what does that mean? That means you've got assets typically in excess of $750,000. You've got a concern, what if I don't use it? And that $750,000 means that you've got enough assets that you can drop some to fund this into this particular product, and it's not going to impact your retirement income. You see, if you have no pension, your retirement income is completely off of your investments. And if we drain your investments to fund this kind of hybrid long-term care, then we've negatively impacted your income in retirement. So you don't want to do that. You want to make sure that you have enough assets that you can siphon some out of your assets, reposition them on your asset column into this product, and then that works. And you've still got money for retirement. Now, you can swap on these. Interestingly enough, there's a little known tax law that allows you to swap an existing life or annuity to one of these with no tax event. So if you've got taxable earnings in, say, an annuity, then you don't have to actually pay the tax on those excesses. You can drop them into one of these, and now you've got tax-free long-term care benefits and a tax-free death benefit. Sometimes people fund it out of lazy money. That's money that's sitting in a CD or a money market, and it's not earning you much, and you're not going to use it for anything else. So there are some different and creative ways you can fund it if you're asset healthy. The other type of household that might want to look into this is this cash flow healthy household. Now, these are really people, again, that have that concern that, well, what if I never need long-term care services? But they also have pension that covers their month-to-month expenses in retirement. I usually say you need $5,000 to $7,000 a month. Why? Because for most people, that's their budget. And as they age over the next 15 to 25 years, the cost of milk, gas, electricity, bread, all that stuff is going to go up due to inflation. So that's not a hard and fast number, but anybody who's got really small income in retirement, you just got to be sure that you're not going to need some of your assets to supplement. That's the crucial thing. Your income in retirement needs to be enough to meet your needs now and down the years as inflation drives price up. So if you've got your monthly nut, your monthly expense covered, but you still have lazy money sitting out here in that CD or money market, and you don't need it, and you don't think you're going to need it, you might use that to fund this. We also have people that have, existing life or annuities, and again, they can swap them here as well. So if you're one of these two, in other words, if you think you've got your income covered, whether it's through your assets or through a pension, and you still think you've got enough that you could fund this, whether it's annual for the rest of your life or a lump sum or a 10 pay or 20 pay, then you might look into it. But if you don't think you meet those, then don't go here, because this is not going to be a right financial solution for you. You want to go with the traditional. And by the way, just so you know, even on traditional insurance, they recommend that you have at least 50,000 in some investment that's not your house for that to be a smart purchase. So it could be, a 401k, it could be farmland, rental property, lake house, oil rights, whatever you got that's not your house, as long as it's at least 50,000 in value, then you probably should be looking into some kind of coverage because you will not qualify for any government assistance with that much assets. So hopefully that's kind of the overall primer on traditional insurance versus hybrid or linked benefit policies. If we can be of service to get you any quotes on this or answer other questions, don't hesitate to reach out. We do work in multiple states across the United States, and wherever we don't work, we've got good professional associates that we can refer you to. Our website is www.mrsltc.com. We have blogs out there on other topics as well, so you might check us out and see if there's anything else out there you had a question on that we can answer for you. Our phone number is out there. Again, if we can be of service, it's our honor to do so. And thank you for coming by and learning about traditional and linked benefit policies.